Hi everyone, this is Eric at the Stock Market Companion Stock Investing course. And today I'd like to share with you a video that answers the question that many of our students have posed and a question that we've talked about in our family this last week about what is the correlation between the Federal Reserve increasing rates and the performance of the broader market and individual stocks. In other words, why does the stock market in this case go down when the Federal Reserve is increasing the federal funds rate? We're going to cover that quickly and in detail here, and we're going to start first with getting an understanding of what's happening with an individual stock that we've been following over the last weeks and months, Ford Motor Company. Let's get started. Okay, let's check out the effect of this Federal Reserve announcing and then actually taking steps to increase the federal funds rate as it applies to an individual stock like Ford Motor Company. Here in the top left corner here you'll see the ticker F for Ford Motor Company, and here you see on the screen a full year view of the share price of the company. We have from last September 2021 we have this tremendous run up, a doubling in the share price in a very nice run in anticipation of Ford competing successfully against Tesla with their new F-Series pickup truck and other electric vehicles. And now as we've moved into January of 2022, we see the final upswing of that uptrend that we see here, and then we see this dramatic decline in the share price. And that dramatic decline continues. We see this downtrend emerging through the first quarter, and then in addition to the first quarter through April and now half of May. So at the beginning of the year, we had the Federal Reserve announcing that interest rates would be increasing, and then on March 15th, we had the announcement by the Federal Reserve that the rate would go up by a quarter point. That was already priced into the market, so we see here a bounce for the share price, a very natural bounce after this type of decline, and then we see a continuation in this downward trend once the investors start focusing in on what the Federal Reserve is going to do next, which was increase rates another half point in May, which is what the Federal Reserve did. And then we see this exhaustion selling here, this bounce, and then perhaps now a resumption of the downward trend. We don't know. During this time frame also, we've had brokerage companies downgrading the share price targets for Ford Motor Company, so there are other factors involved as well. But overall, you see here a picture-perfect example of what can happen to an individual stock, the stock of an individual company, when the Federal Reserve announces and then begins increasing the federal funds rate, and then the expectation for further increases in the federal funds rate that are not modest. Let's continue on with the background on what is taking place overall with the federal funds rate, and why does that federal funds rate have such an impact on the market? Okay. Here is the question that everyone wants answered, and that is, why is the stock market going down in value when interest rates go up? And remember, at the Stock Market Companion Stock Investing course, we are providing information for instructional purposes only. The stock market and stocks go down mostly due to this primary reason. Future earnings at individual companies are being revised lower. Remember, the stock market and the share prices of a company reflect anticipated earnings in the future. When expected or forecast future earnings of companies decline, then the share price of the companies decline in value. For example, on average, investors are willing to pay about 16 to 19 times annual earnings per share for the shares of companies. That's why when we talk about the price earnings ratio of companies, something around 16 to 19 is a number that we expect to see for an individual company, unless it's in an unusual growth cycle. So, for example, if the annual earnings for Ford Motor Company are expected to be $1.25 a share, and those are now adjusted lower to about 90 cents a share, then the share price would look like this if we use the S&P 500 average of an 18 price-earnings ratio as a guide. So, the previous expectation of $1.25 annual earnings per share at Ford Motor Company times 18 as an average price-earnings ratio for the market would result in an approximate share price of the company of Ford Motor shares of $22.50 per share. But when we revise those future earnings expectations down to 90 cents a share annual, then 90 cents times 18 would result in a $16.20 share price. So now comes the second important question. But I thought that stocks were going down because interest rates are going up. How does this relate to the future earnings at the company? When the Federal Reserve begins increasing the federal funds rate, that has a direct impact on what the prime interest rate is going to be. And the prime interest rate is the rate that commercial banks charge customers. So the prime interest rate impacts what the mortgage rates are going to be in our country and also credit card annual percentage rates. So as you can imagine, when those rates go up, consumers will spend less. Their cost of borrowing has gone up. Therefore, when consumers spend less, companies sell less. Their sales decrease. And when companies sell less, their net earnings per share decline. So, as we've covered, share prices go down when company earnings per share decline. Remember also that when the prime interest rate goes up for consumers, it also goes up for companies. So if companies need to borrow in order to function or produce their product, their borrowing costs are going to be higher. And if their borrowing costs are higher, that also negatively impacts earnings. And that's why when the Federal Reserve is increasing the federal funds rate, the share prices of individual companies in the broader market will likely go down. Stay tuned for more videos from the Stock Market Companion, and we'll look forward to seeing you next time. Be sure to see more about our course at thestockmarketcompanion.com. See you next time.